So you're sitting on a massive pile of highly appreciated company stock. Sounds like a dream, right? Well, actually, you might be feeling incredibly trapped right now. You look at your portfolio, and you absolutely know that having so much of your net worth tied up in just one single company is a huge risk. But the second you even think about selling some off to diversify, you are staring right down the barrel of a colossal capital gains tax bill. It's stressful. It's literally the dilemma of success. But today, we're going to explore a wealth management strategy that attempts to thread the needle right between that risk and those taxes. Welcome to this explainer. Today, we are going to completely unpack the realities of a Section 721 exchange fund. We're going to look under the hood of this complex strategy so you know exactly how it works. My goal here is simple. I want to arm you with the precise knowledge you need so you can walk into your next meeting with your tax or legal advisor ready to have a highly productive, informed conversation. We're going to make sure you understand the brilliant advantages for sure, but also the hidden sacrifices you'll have to make. Here is our roadmap for today. We're going to start by looking at the concentrated stock trap, then break down the mechanics of how 721 exchanges actually work. From there, we'll hit the hard tax reality, talk about the sacrifices in liquidity, fees, and control, and finally, look at how to make the right choice for your specific situation.
Okay, let's dive right into the dilemma of success.
To really understand why this strategy exists, we have to look at the sheer scale of the tax penalty we're dealing with. Let's use a stark example directly from our source material. Imagine you own $5 million of your company's stock, but your original cost basis, what you originally paid for it, is just $135,000. If you decide to just sell those shares on the open market today to diversify your portfolio, well, you don't just get to pocket $5 million free and clear. Selling that could instantly trigger a staggering $4.865 million of taxable gain. Just boom. It's a massive tax event. And honestly, this is exactly why investors start looking for a bridge, some kind of way to reduce that massive single stock risk without having to recognize that entire multi-million-dollar gain all at once. So, how do we build that bridge? Let's look at how these exchanges actually operate. How do you step away from single stock risk without immediately triggering the tax man? Well, it happens in 3 steps. Step 1, instead of selling your shares, you actually contribute them into a managed partnership. Step 2, inside that partnership, your stock is pooled together with securities brought in by a bunch of other investors. And step 3, in return for your specific stock, you get an ownership interest in this new diversified fund. Because your money is now tied to a whole pool of different assets, rather than just your one company, you've successfully cut down your dependence on that single stock. And here is the kicker. If the managers structure this properly, your contribution to the partnership might be entirely tax-deferred. Sounds pretty much like magic, doesn't it? Well, hold that thought because we need to look a little closer. Which brings us to the big catch, the tax reality. This is absolutely crucial to understand before you talk to your advisor. We need to be crystal clear on this definition. Tax deferral means postponing the payment of taxes to a future date. It does not mean erasing the tax liability entirely. I mean, let's be real. The IRS rarely just forgets that you owe them money. When you enter this managed partnership, that incredibly low original cost basis, remember that $135,000 from our example? It follows you right into the fund. That embedded gain is firmly attached to your investment. You definitely haven't escaped it. You've really just kicked the can down the road. Let me reiterate this with a direct quote from the source material. The tax is deferred, it is not erased. A lot of folks incorrectly assume that if they just wait out the mandatory holding period of the fund, which is typically 7 years or more, the tax will somehow just magically vanish. It doesn't. After that 7-year period, when you finally exit the fund, you'll generally receive a diversified basket of securities. But those new securities, they might still have a very low tax basis. If you ever sell them, you're going to recognize some or all of that deferred gain. So fundamentally, this strategy is really just replacing one concentrated low-basis stock position with several diversified low-basis stock positions. Okay, so what else are you giving up here? Let's talk about liquidity, fees, and control. Deferring a massive tax bill means making some pretty major compromises on your end. First up, liquidity. This isn't your standard brokered account. You can't just tap into it whenever you want. You are generally locked in for at least 7 years. Need the money early? Your options are going to be severely limited, heavily delayed, or totally taxable. Second, control. You're handing over massive amounts of decision-making power. The fund manager decides when your original stock gets sold, what the partnership buys, and what specific securities you'll get when you eventually leave. Third, fees. These are highly complex funds, and trust me, they charge for it. You're looking at management fees, admin expenses, organizational costs, the whole shebang. And finally, tax reporting.
Say goodbye to that simple 1099 form at tax time. You are now going to be dealing with a complex Schedule K-1, which might allocate dividends, capital gains, real estate income, and even multi-state income. Now, I want to highlight a really shocking nuance from the source material regarding that loss of control. The partnership might actually sell your contributed stock before you exit the fund. Just let that sink in for a second. Even though you didn't personally click sell, the fund manager might decide to sell some or all of your shares after you contribute them. If that happens, part of that huge built-in gain we talked about, it gets allocated right back to you through your K-1. That means you could end up owing a massive tax bill before you even leave the fund. In some cases, you might owe tax even if the fund didn't distribute enough cash to you to actually cover the bill. That's why figuring out the fund's specific tax distribution policy with your advisor is absolutely essential. You also need to know what you're actually going to own inside this fund. Exchange funds aren't always just big baskets of publicly traded stocks. To satisfy specific tax rules, they often contain a mix of public stocks, real estate, and private investments. Holding these less liquid assets introduces a whole bunch of new variables to your financial life. We're talking leverage, valuation uncertainty, private market risk, extra expenses, and that multi-state tax headache we just mentioned. So yes, you're getting diversification, but you are also inheriting a very complex basket of private fund restrictions. So how do we weigh these trade-offs and make the right choice? The most crucial takeaway from this explainer is understanding the actual choice in front of you. So many people walk into their advisor's office thinking the choice is simply pay taxes today or pay no taxes. Actually, scratch that, it's totally the wrong way to look at it. The real choice is this. You can sell and diversify today, take the tax hit now but gain immediate freedom, total liquidity, and full control of your money. Or you can defer the tax and accept the restrictions, meaning you avoid the immediate tax bite but you accept the high fees, the messy tax reporting, the loss of control, and a strict lockup period for 7 years or more. And remember, before you commit to a 7-year lockup, a 721 exchange is just one tool in the toolkit. In your meeting, you need to compare it against alternatives. What about a stage sale over multiple tax years? Or using charitable planning? Maybe direct indexing, hedging strategies, or honestly, just keeping a part of the concentrated position. This is especially critical if you're dealing with special situations like insider restrictions, founder stock, or qualified small business stock, also known as QSBS. You really have to tread carefully there, because throwing QSBS into an exchange fund could accidentally destroy a massively valuable tax exclusion you already have. So we end with this final provocative thought. This is the exact question you should use to set the agenda for your follow-up meeting with your tax or legal professional. A 721 exchange fund can be a powerful tool when you have a large, low-basis position, you desperately need diversification, you definitely don't need the cash for at least 7 years, and you can stomach private fund restrictions. But remember, the goal isn't just to avoid selling. The goal is to reduce your risk while actually improving your overall financial outcome. So I leave you with this. When you factor in the 7-year lockup, the fees, giving up control, the private investment exposure, and the tax liability that is still waiting for you at the end of the road, does the value of this deferral truly outweigh the cost to your financial freedom? That is the question you need to answer next.